Hey guys, this is James and I'm back with another valuation video. Today we are looking at ticker symbol KO or Coca-Cola Company. Their current price is sitting at $53.43, and what you're looking at here is my valuation spreadsheet. This is part of my workbook that I offer over on Patreon. Here's an overview of all of the calculators I have built so far that are public. I have workbook instructions how to use this entire workbook, as well as how to use every single spreadsheet in this workbook. Today we're looking at the intrinsic value of Coca-Cola. Is Coca-Cola a good buy or not? Coca-Cola, as you can see, has been down here over the past 2 to 3 months, and it's coming back down almost to some of the very similar prices as it was around 2 years ago. So that has me questioning if Coca-Cola is coming closer to a buy signal based on its intrinsic value. And we're going to value Coca-Cola based on the Graham's model, the discounted cash flow model, and the dividend discount model. The P to A FFO ratio model and the net asset value model is for our REITs only. So just to fill out this spreadsheet here, no, KO is not a REIT. Apply a margin of safety. Yes, we would always like to apply a margin of safety. We're going to apply a 12% margin of safety, and later on in the video, I'll show you how to use my guide to margin of safety estimates. And then just real quickly, type in here, how close are you to pulling from your investments? How close are you from retirement? And then first up, we come to Graham's model. Now, all we need for this calculator, the formula is built into the calculation right here under value. All we need for this model is the growth rate and the AAA corporate bond rate. Currently, the AAA corporate bond rate is sitting at 5.48%. And again, this is a quick Google. Just simply type in AAA corporate bond rate into the URL bar, and up pops the current corporate bond rate. And then all you need for this formula is the growth rate over the next 5 to 10 years of the earnings per share growth. So where am I getting 7 at? Well, over on my favorite stock analysis website, Seeking Alpha, here's the Coca-Cola page. If you go to the earnings tab under earnings revisions, we take a look at their earnings per share estimate over the course of the next 10 years. And these are what analysts are estimating the earnings per share for Coca-Cola to be. And here are the estimated growth rates year over year. So for the first year, or at the end of this year compared to 2022, they are expecting a 6.27% growth rate, and then close to a 6%, close to a 7%, 5%, 15%, 5%, 6%, 6%, 5%. So I would very safely estimate anywhere between a 6 to 7% growth rate for their earnings per share growth. So I went ahead and chose 7 for the Graham's model, and once we click Go here on this calculator, after we have determined where we get these other figures, then the intrinsic value will show up for each of the valuation models that we use. The discounted cash flow model is next, and it is the most accurate as well as the most involved. First, we have to find the free cash flow numbers for the 12 trailing months, and then the full years going all the way back to 2014. Coming back over to Seeking Alpha, and currently I believe Seeking Alpha is giving, through my link, giving at the first 7 days free. You get unlimited articles, and you also get unlimited access to all of the financial metrics under each ticker symbol. Coming back to the DCF model, if we come to financials and cash flow, come all the way down to free cash flow per share, we can see their free cash flow per share has grown slightly here up to about December 2022, but the 12 trailing months here, it looks like their free cash flow has pulled back slightly from December 2021, where they peaked out at $2.61 per share. So what we do here is take all the way back to December 2014, $1.87, all the way up to $2.19, and then we have to multiply that by the number of shares outstanding. Where do we find the shares outstanding? If we come over to balance sheet, all the way to the bottom, multiply by the total common shares outstanding each year multiplied by the free cash flow per share, which gives us the free cash flow for that year. And it looks like the free cash flow for these years I've already put them in the calculator and abbreviated them in the billions. And over here to the right of the calculator, I do have some, I guess what you call the brains of the calculator. Free cash flow growth for the discounted cash flow model. This is the year-over-year growth. They did have some negative growth from 14 to 16, slightly positive in 17, slightly positive in 18, 19, and 20, but then some negative growth in 21 and 22, with their average growth being close to about 3 to 4%. Perpetual growth rate, typically I'm going to stick 0.5% in there. The discount rate, typically I'm going to be putting a 8% in there. And then finally, last but not least, total cash and total debt. Coming back over to Seeking Alpha under their valuation tab, just take note of this. You can see that Seeking Alpha is actually evaluating Coca-Cola as a D rating under valuation. So that should be a little, I guess, precursor to what we get on our calculation. But let's go ahead and finish out our calculation and see how it compares to Seeking Alpha's metrics. We're trying to find the total cash and the total debt. The total debt for Coca-Cola is $43 billion and the total cash is $15.69 billion. Let's use these two numbers and then put them in the DCF model. Last but not least, dividend discount model. We are taking the annual dividend payout and the 5-year dividend growth rate. We're going to find these two numbers right here on Seeking Alpha. The risk-free rate or the 10-year bond yield, we can find that with a quick Google. And then what type of return of the market would you like to see? And conservatively, let's say we would like to see 8% return on our money. So where do we find these two figures? Again, back over at Seeking Alpha under the Dividend Scorecard. Annual payout, $1.84. That is our first figure. And then 5-year growth rate, 3.4%. And I just want you to take a look here. Dividend growth, they have been growing their dividend for the past 60 years. Let's take a look at the dividend history for Coca-Cola. If we click the Max tab here, Seeking Alpha has only pulled the data back from 1990, but I'm sure they have been paying and growing their dividend a lot longer since 1990. In fact, as we saw on the other page, it was 60 years. As you can see, they've gone through a bunch of stock splits, so that does adjust the dividend payouts previous to 1990, less than a penny or two, so that does skew the results here a little bit, meaning that the dividend payout prior to 1990 was less than a penny based on today's prices for Coca-Cola, based on the stock splits. If that doesn't make any sense, that's all right. It doesn't matter because we are here in 2022 and they have been paying a dividend for close to 60 years, which is pretty much the best on the market. So I would expect the dividend discount model to give us the largest valuation, just because this is a very long-standing company with a close to 70%. If we come back over to the Dividend Scorecard, almost a 70% payout ratio, meaning all their free cash flow, all the extra cash generated after all the bills are paid for, 70% of it is going to a dividend. So we're going to skip these two valuation models, which are for REITs. We're going to go ahead and click go, give the calculator a little time to think. And as we thought, the dividend discount model is valuing Coca-Cola at $59.03, which is about $6 higher than its current price. However, the discounted cash flow model is measuring Coca-Cola at $31 and Graham's model is $43. Now remember, the Graham's model bases its intrinsic value based on the earnings per share growth. The discounted cash flow is basing its intrinsic value on the free cash flow growth, which is only about 3 to 4%. And the dividend discount model is evaluating Coca-Cola based on its dividend payout and its dividend growth. So averaging these three together, we get $44.73. Now down here to our margin of safety. Now if you don't want to apply a margin of safety, we will go ahead and click no here, and our intrinsic value comes to the same as the average valuation here, which is still 16% overvalued. This price is still 16% higher than our intrinsic value. But if we do apply a margin of safety, and what we do here is if you are at 15 years or more from pulling from your retirement, 15 plus years, go ahead and apply a smaller margin of safety. And I also just gave a little quick guide here. I guess you could say, if you are a mega cap, if you have a company larger than $200 billion, probably a pretty safe investment. They're probably paying a very decent dividend, or they have some large cash flows like Apple or Microsoft. You can apply a smaller margin of safety. However, if you are closer to retirement or pulling from your retirement funds, I would apply a much larger margin of safety. Be a little bit more conservative with your cash. If you are a micro cap stock, I would apply a very high margin of safety because you want to be very conservative with the money that you do invest. So in the end, with a 12% margin of safety, Coca-Cola is about 26% overvalued based on its intrinsic value. Let me know if you agree with this valuation. Head down into the comments and let me know if there is another ticker symbol you would like analyzed with this way. And with that, thanks for watching.